Welcome to vTalkInsight, Risk Sentiment Daily for January 7th, 2026. Global markets are charging into the new year with equities at record highs, AI stories dominating headlines, and fiscal stimulus gathering pace, even as policy and geopolitical risks simmer in the background. Let us unpack what this firmly risk-on tone and the emerging fault lines beneath it could mean for portfolios today. Risk sentiment is firmly risk-on, with price action and positioning pointing to broad confidence in the macro and earnings outlook. United States equity benchmarks closed at record or near record highs, with the S&P 500 edging toward the 7,000 level and the Dow trading above 49,000, while the Nasdaq 100 and Asian indices posted sizable gains, helped by technology strength and upbeat reactions to major AI announcements. Credit markets are echoing that optimism, with heavy bond issuance being readily absorbed and spreads staying tight, and the volatility index hovering in the mid-teens, all consistent with investors embracing risk rather than rushing for protection. Underneath that price action sits a narrative of above-trend growth, resilient labor markets, and expectations that earnings will broaden beyond mega-cap technology. Commentators point to cyclical sectors such as financials, transports, and consumer discretionary leading the latest leg of the rally, while small caps and global financial stocks begin to participate, suggesting that investors see the expansion as durable rather than narrowly driven. Commodity markets reinforce that message, with copper and other industrial metals at or near record highs, signaling confidence in global industrial activity and in the capital spending wave tied to electrification and data centers. At the same time, there are clear signs that the mood may be edging toward complacent, not just constructive. Strategists note a scarcity of bearish equity targets, very low volatility, and rich valuations across equities and credit, even as macro indicators such as new order surveys look less robust, highlighting a growing gap between market pricing and economic data. Flows into gold, silver, and even the United States dollar show that some investors are quietly building hedges against late cycle and geopolitical shocks, but overall, markets remain focused on the upside, with tail risks still underpriced in this risk-on regime. A key bullish driver is disinflation, combined with expectations for rate cuts and powerful fiscal support. Recent inflation prints have tended to surprise on the downside, with observers highlighting persistent disinflation and a clear slowing in shelter costs, while unit labor costs decelerate thanks to productivity gains, creating what many see as a disinflationary growth backdrop. The labor market is cooling rather than cracking, with unemployment drifting higher but still moderate, and that mix of softer wage pressure and still solid activity supports the view that the economy can slow without tipping into a deep recession. On top of that, markets broadly expect the Federal Reserve to deliver around 3 rate cuts over the coming year, even if the next meeting is likely to bring a pause and limited guidance while policymakers debate the path ahead. Some participants argue that political incentives ahead of midterm elections and a desire to sustain consumer activity tilt the balance toward easier policy, particularly if unemployment were to move above roughly 4.5%. Commentary also notes that a moderate jobs backdrop and declining inflation could give the Fed cover to ease, which investors see as a potential tailwind for risk assets, reinforcing the current pro-growth positioning. Fiscal policy is adding another powerful layer of support. Estimates point to a $600 to $700 billion fiscal impulse in the United States alone, worth roughly 2 to 2.5% of gross domestic product, much of it tied to retroactive tax changes and what could be one of the largest tax refund seasons on record. Households benefiting from expanded deductions may see material increases in monthly cash flow, while potential rebate checks and broad-based consumer and industry support in the United States, Germany, and Japan are expected to boost demand, forming a potent cocktail of disinflation, prospective rate cuts, and fiscal easing that keeps investors comfortable with a risk-on stance, even if some worry that such stimulus could later restoke inflation. AI-driven growth and tech leadership remain central to today's bullish sentiment. Capital expenditure on AI infrastructure is surging, with projected data center buildouts rising from around $150 billion in 2023 to more than $500 billion in 2024, and United States technology capex linked to AI now accounting for well over a third of total corporate spending. This wave of investment is underpinning strong demand for semiconductors, cloud providers, and infrastructure finance, and it is a key reason why investors expect above-trend growth and robust earnings from technology and adjacent sectors for several years. Company-specific developments are reinforcing that theme. NVIDIA continues to be highlighted as a top conviction holding, with consensus pointing to very strong earnings growth and valuations that have normalized toward the mid-20s on earnings, making the story feel less like pure multiple expansion. The new Vera Rubin platform promises multiple-fold increases in AI training speed and an order of magnitude reduction in operating costs, while competitors like AMD and Intel are launching their own next-generation AI chips, intensifying innovation and keeping investor focus squarely on the sector. AI optimism is also spreading into the real economy and other asset classes. CES commentary points to AI moving from concept to product, with hundreds of millions of smartphones expected to ship with embedded AI assistants, while enterprise software firms using AI agents report tangible productivity and profit gains, even if many of those opportunities remain in private markets. Rising electricity demand from AI data centers is driving deals such as large acquisitions of natural gas plants and is contributing to higher demand for metals like copper and aluminium, helping explain why tech-led rallies in the Nasdaq 100 and Asian indices are being accompanied by strength in commodities and infrastructure-linked credits, even as some observers flag eventual risks if AI returns on capital do not materialize as expected. Another supportive factor is the broadening of earnings and market leadership beyond a handful of mega-cap technology names. Projections now show 7 of the 11 major sectors delivering double-digit earnings growth by 2026, and earnings for the so-called S&P 493 are trending higher even as growth for the former market leaders slows. This shift suggests that the bull market is transitioning from being driven primarily by multiple expansion in a narrow slice of stocks to being powered more by underlying profit growth across a wider set of companies. Cyclical sectors are already reflecting that change. Financials, industrials, transports, and consumer discretionary stocks are cited as leaders in the current rally, while global financial shares, particularly in Europe and Japan, are rebounding from years of underperformance and are seen by some as still offering catch-up potential. Market breadth has improved, with small and mid-cap equities participating, and international markets in Asia and Europe recently outperforming the United States, helped by more attractive starting valuations and an inflection in earnings growth expectations. The risk-on tone extends beyond public equities. The IPO market is reviving, with expectations for hundreds of deals and tens of billions of dollars in issuance, while private equity is anticipated to benefit from both broader earnings growth and a pickup in capital markets activity, including IPOs and M&A, against a backdrop of resilient growth and gradually easing financial conditions. At the same time, strong rallies in industrial metals and mining stocks, as well as renewed interest in crypto where spot Bitcoin and Solana ETFs are seeing significant inflows, underline just how wide the current risk appetite has become, even though many forecasters still expect index-level equity returns to moderate from recent outsized gains. Against this upbeat backdrop, valuations, concentration, and complacency risks are building as important counterweights. Commentators flag that United States equities are trading at elevated multiples, with aggregate index valuations high and credit spreads tight, even after a multi-year rally, while consensus still calls for respectable single to low double-digit returns. Some see this as leaving less margin for error if earnings disappoint, growth slows, or policy outcomes are less friendly than markets currently anticipate. Concentration is a recurring concern. The top 10 S&P 500 constituents now account for roughly 40% of the index, and United States assets overall dominate global benchmarks, comprising close to 90% of major equity and fixed income indices, making diversification away from the United States challenging in practice. Investors are increasingly looking to hedge concentrated gains in mega-cap stocks, and similar dynamics are visible in crypto, where a large share of Bitcoin supply sits in a small number of wallets, amplifying the risk that any profit-taking by those holders could translate into sharp price swings for newer ETF buyers. These structural issues are compounded by signs of complacency. The scarcity of bearish strategist targets, low volatility, and a culture of buying every dip, especially among younger investors who have not experienced a prolonged bear market, raise the risk that any negative shock could provoke an exaggerated reaction. There are also questions about whether earnings expectations, including forecasts of mid-teens profit growth for the S&P 500 in 2026, are too optimistic given macro headwinds and the reliance on a small group of tech leaders, which means that, even in a risk-on environment, valuation, concentration, and sentiment froth are important sources of downside risk. A second major bearish driver is the risk that fiscal and tariff dynamics rekindle inflation and push yields higher. While current disinflation trends are supportive, the size of the looming fiscal impulse, including hundreds of billions of dollars in tax-related stimulus, expanded deductions, and potential rebate checks, is expected by some analysts to generate renewed inflationary pressure in early 2026. Retailers are already anticipated to pass through tariff-related cost increases, and larger tax refunds could boost disposable income and spending, raising the possibility of an inflationary bump even as headline inflation has been trending lower. Trade policy is adding another layer of complexity. Higher tariffs on key industrial inputs such as aluminum, steel, and copper are reported to be raising construction costs and slowing new factory projects, while restrictions and the threat of further measures on refined products have concentrated copper supplies in the United States, contributing to global shortages and record prices. Metals such as copper, silver, and nickel have surged, and although some of the move reflects strong demand from electrification and AI-related data centers, it also feeds into broader cost pressures that can complicate the disinflation story. On the rate side, there is concern that these forces could translate into higher yields and a steeper curve. Some forecasts see 10-year Treasury yields potentially moving above 4.75%, as persistent fiscal deficits and inflation worries overshadow recent or prospective Fed cuts, and there are warnings that any perceived erosion of Federal Reserve independence could steepen curves further through higher term premia. A more hawkish tilt in the upcoming Federal Open Market Committee voting rotation, and the possibility that strong growth delays rate cuts into 2026, underline the risk that the current easing narrative is challenged by inflation and yield dynamics, with clear implications for long-duration assets and equity valuations. The third key bearish driver comes from geopolitics, trade tensions, and a more fragmented global order. Events in Venezuela, including direct United States intervention and discussions about securing oil infrastructure, have sharply increased geopolitical risk in Latin America, with implications for emerging market assets and for global energy flows. While oil markets currently appear relaxed thanks to a sizable supply surplus, analysts note that Venezuelan production remains constrained by sanctions and underinvestment, and that any misstep could reignite volatility in crude and in regional bond and equity markets. Beyond Venezuela, broader strategic tensions are in focus. Escalating rhetoric around United States ambitions in Greenland, and warnings from Danish leadership that military action there could effectively dissolve NATO, represent an extreme but non-trivial tail risk for Western alliances and defense frameworks. At the same time, frictions around AI hardware exports to China and trade disputes over metals and refined products underscore a deglobalizing environment where supply chains are becoming more politicized and regionalized. For now, markets have largely looked through these risks, focusing instead on growth and technology stories. Global equities remain near record highs, and risk appetite has held up even as geopolitical headlines multiply, but persistent demand for gold and other precious metals and strength in the United States dollar at times of stress indicate that investors are using safe havens to hedge against potential escalation. The key question for risk sentiment is whether these geopolitical and trade tensions remain a distant background concern, or whether a future shock forces a rapid repricing of assets that are currently priced for a benign, risk-on world. To sum up, markets are entering this week in a firmly risk-on mood, powered by disinflation, expected Fed easing, sizable fiscal support, powerful AI-driven growth, and a broadening earnings and geographic story that extends well beyond a handful of mega-cap names. Set against that are growing fault lines, stretched valuations and concentration, the risk that fiscal and tariff forces reignite inflation and lift yields, and a more fractious geopolitical and trade backdrop that could challenge today's low-volatility, high-confidence regime. Watching how these bullish and bearish forces evolve in inflation data, policy signals, AI investment returns, metals prices, and geopolitical flashpoints will be critical for understanding how the balance of risks for multi-asset portfolios is shifting. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.